Well, good morning, everyone, and welcome to Contact Energy's first half 18 results presentation. We'll run through a fairly standard agenda on page 3 after you've read the normal disclaimers. Graham's going to do all the heavy lifting in section 4, and I'll pass to Graham soon. And we've got Matt Forbes in the room with me and Jason, who handles our external communications. So on page 4, I think it's the first time in a long time, it's fair to say we've got a pretty clean set of accounts, other than for 2 early adoption of accounting standards, no transition costs, no adjustments. So I think we're delivering on what we said we would do at the full year, which is to be transparent and clean and focused on cash. Now, cash flow is up in the period, and we have delivered on the promise to increase dividends to shareholders. But you can see the result has been impacted at the earnings level by weak hydro inflows. I think in the media release, we referred to the inflows as being unprecedented, given we've not seen that low level of inflow since records began, which I think go back to 1932. But the increased cash flow, the increased dividend, as a whole, occurred in the context of an improving customer experience. Customers are advocating for us more, and the operational performance of our generation business continues to improve. So some of the highlights for me, maintenance of financial discipline, a 19% reduction in total cash operating costs and capital spend in the period, 25% improvement in NPS. We maintain an excellent safety culture with very low levels of incidents, and in the period improved the engagement of our staff as tested earlier in the year. At the full year, we said we would increase dividends in the year to 32 cents. That was our target, and we would pay out 40% at the interim, 60% at the full year, and we've confirmed today that we will in fact pay out slightly more than 40% and fully frank it. Just as a reminder, we have moved the date of that payment to April, which is what we foreshadowed in August. So they're the highlights. What's going on in the market? I think everybody's pretty aware that we've had very low South Island inflows, with reasonably high North Island inflows, which has seen a shift towards more thermal generation in the half, with a chart provided on the bottom right of that page 7, which shows quite a swing in variation in generation type half on half, with more thermal being run by Contact and Genesis, and much more less hydro by Meridian and Contact, with Mercury benefiting from a 1 in 7 inflow sequence in the North Island. Demand has been a bit variable. It is on average up in the first 6 months, but most of that is irrigation load and a cold July. I think we're continuing to see the multi-year trend where the demand from the growth in new connections is offset by lower use per customer, and we're certainly seeing that in our customer base. The numbers have swung about quite materially by the irrigation demand at South Island nodes in the first half. In retail, we see a continued competitive market. In fact, in the last quarter of the year, reported by MB, energy and retailing costs reduced, which is somewhat incongruous in a context of a very volatile and higher price wholesale market. We're not seeing that flow through to retail activity, and we've not really seen a retail pricing response to that increased volatility. So that tells me that competition in the retail market is alive and well. Wholesale electricity prices did respond to very low inflows, very low snowpack, and we have seen a fair bit of volatility in futures prices. One heartening thing that we've seen through all of that volatility is that long-term futures prices remain relatively stable. You may say that's not very heartening because you've had this volatility and you would want to see wholesale prices increase. But I think I've said on a few occasions that the long-dated price is more a function of long-run marginal cost of new generation and the short-run marginal cost of thermal supply. And we've seen the long-term futures price be very stable through this period of volatility. We managed the volatility through our thermal plant and through calling on some hedges with other generators. We weren't able to take full advantage with our thermal plant because we had the Taranaki combined cycle plant on outage during November and December, scheduled way in advance and scheduled for what is normally a period of relatively benign conditions. Where we did have volatility and we did have plant, we chose to run where we could see a return on capital for that plant. But the big story is we had 590 gigawatt hours less hydro generation than we did in the prior period. And depending on when that occurs and the alternate fuels we use in those low inflow sequences, we increase our cost by somewhere between $350,000 and $1 million per gigawatt hour. And we quote that figure later in the presentation. So that's what's going on in the market. Reasonably volatile in wholesale, doesn't seem to be affecting the competition in the retail market, and a sequence which we've never seen before, and we were able to maintain and grow our cash flows, so we're pretty confident that our portfolio works in these stressed environments. On our strategy hasn't changed. We're going to optimise the customer and generation businesses to deliver strong cash flows, underpinned by a disciplined approach to spend and continuing to investigate ways to optimise our portfolio. The customer business has reduced costs to serve, improved the customer experience. It's been focusing on cost reduction, customer journeys and digitising those journeys, automation of processes, and continuing to evolve the IT model which will serve our customer needs into the future. And we've been able to do that at a lower cost. Customer advocacy improved, customer connections increased, a little bit of a dip in electricity, but a reasonable growth in gas and LPG. Quite a bit of change in our product structure in the year, and all resulting in a churn which was below the market average. Generations on a similar theme, sustainable cost reduction evidenced in the period, record geothermal production, and I'll come to that later, and we continue to innovate to reduce that cost of production, given that in due course we fully expect the government's decarbonisation agenda to create some opportunity for us. Previously announced, but we've not had time to do the rounds, we have entered into a conditional agreement to sell Ahuroa. The conditions are being worked. We are targeting June this year, and we see no reason why we won't meet that target. That's old news, but it does evidence progress on our strategy in the period. And like I say, because we announced it usefully on the 21st of December, we haven't had a chance to talk to you all about that. Having said that, Meridian did some of the next day, so they get the prize. But as we've said, you know, our biggest focus at the moment is how do we get an improved customer experience, excuse me, improved operations, while still reducing cost, because we see that as being the highest value activity today. And in the period, we've taken operational costs down $11 million, combination of labour, bad debts, various small initiatives across all of our business, and a continued move of IT to the cloud. So with that, which is our financial focus, I'll hand over to Graham, and Graham can take us through the detail of what happened in the period.
Thanks very much, Dennis. So if we turn to page 19, start there with a reconciliation of the statutory and underlying profit measures between the first half of FY17 and the first half of FY18. You can see the underlying profit is down by $23 million, about 28%. That's largely as a result of the $28 million reduction in EBITDAF. Depreciation and amortisation was $8 million higher than last year, and that's primarily due to the increased running of our Taranaki combined cycle plant and the results of a useful life review on some geothermal wells. You'll see in the supporting materials in the back of the pack that we've confirmed our depreciation and amortisation guidance for the full year of between $215 million and $220 million. Net interest costs continue to improve year on year as we reduce our level of debt and average funding cost. Our average rated cost of borrowing in the first half of FY18 was 4.9%. That's down 0.3% from the first half of FY17. If we turn to page 20, that breaks out the EBITDAF result into the two segments. You can see the customer segment was down $3 million against the first half of FY17. Electricity and natural gas ended flat overall, while the LPG segment was down $3 million on higher product costs. The EBITDAF of generation segment was down $25 million compared to the first half of FY17. And that's, as Dennis referred, largely as a result of the lower inflows in the first quarter and lower sales volumes to the customer segment. The next two slides, 21 and 22, provide a bit more detail on the performance of the customer segment. I won't go through the entire slides, but I think the key messages from the slides are that for the mass market, improvements in our cost to serve were offset by higher network charges and lower volumes. I think the difficulty of achieving and sustaining netback improvements in mass market reflects the degree of competition in the market. The C&I market also remains highly competitive with lower margins and volumes, reducing EBITDAF by $2 million compared to the prior period. We saw natural gas volumes up over last year, which led to an improvement in the EBITDAF of the natural gas segment of $2 million. And the LPG business saw good volume growth over last year, but was impacted by higher product costs, which are linked to the increase in oil prices. If we go to page 23, for generation, there the key messages clearly around the hydrology. So the dramatic decline in first quarter inflows reduced half-year hydro generation by 21% over the first half of FY17. Geothermal production was up 11% as a result of a favourable variation in the consented mass take on the Wairaki field. The net effect of these reduced renewable volumes is essentially the sum of the first four columns in the chart, noting that it would have been quite a bit worse had it not been for that additional geothermal volumes that we got as a result of the consent variation. As our contract to support Tiwai only began in 2017, the impact of this contract is visible on the half-on-half comparison. You can see it there in the chart. And then, in addition, lower sales volumes to the customer segment reduced the generation segment EBITDAF by $5 million. If we turn to page 24, this really is about risk management, I think. It's clear that our first half performance was impacted by variations in hydrology and, to a lesser extent, the international price for LPG. Our risk management framework and asset portfolio are designed to deal with this sort of variability. We regularly test our portfolio position and adjust our sales, gas purchases, or third-party hedges as required. On LPG, we try to manage LPG pricing so that our customers don't feel every up or down movement in international prices. However, the recent sustained increases in product costs mean that pricing in all channels is currently under review. Turning to slide 25, talk here about OPEX and CAPEX. Dennis mentioned this earlier. Clearly a key focus for the business is to improve the cash cost overall. Our reported other operating expenses of $114 million are $11 million lower than the first half of FY17. And the slide there highlights the main sources of that improvement. On CAPEX, we continue to make good progress in reducing our annual spend. Our first half cash CAPEX was $26 million lower than the first half of FY17, and we remain on target to deliver a full year spend of $75 million, which is in line with our previous guidance. Turning to slide 26, operating free cash flow. As Dennis mentioned earlier, again, was up on the first half, $141 million, $7 million higher than the first half of FY17. Really as a result of the reductions in CapEx interest costs more than offset the lower EBITDAF during the period. And on slide 27, looking at the balance sheet and dividend. The slide here sets out where we've applied free cash flow generated during the year. As you can see, we've used $14 million to reduce our debt levels. This is less than we had planned, but clearly the extreme hydrology meant that cash flows were also less than expected. Nevertheless, the board has decided to pay an interim cash dividend for FY18 of 13 cents per share, a 2 cent per share improvement on last year. And as we signalled last year, we moved the payment date to April in order to better manage the use of imputation credits. And as a result, we are now able to fully impute this dividend. And with that, I'll hand you back to Dennis.
Thanks, Graham. I'll talk a little bit about short-term outlook and a little bit more about the longer term. Firstly, in what I would call the short term, there's sort of a reasonable balance of opportunities and challenges. In opportunities, clearly hydrology is going to drive short-term earnings. We have now got all of our plant back in service after the usual maintenance season. He says with a bracket that TCC trip this morning. And assuming that we do continue to see this La Nina sequence, then we will be able to get some length with our thermal kit. Of course, if it hoses down, that's good for us as well. But it is going to be a period that's defined by this La Nina sequence, which is still in place, but weakened after that cyclone event of the last week or two. We had a year where we had very little C&I load to be recontracted. Obviously, that increases over time, so short-term futures prices are a bit higher. We'll continue to deliver on our continuous improvement opportunities to keep getting the cost down. And we think, even in the short term, there's opportunity with customers to benefit from the decarbonisation agenda. On the challenges side, again, it's really a hydrology story. Every gigawatt hour below mean we don't get of hydrology. We have a cost range of $350,000 to $1 million. You can't really pick the middle and you can't really pick the extremes. It is really down to market conditions at the time. You could do the average, of course, for the first half of the year. We still have very low storage in the South Island with low snowpack. This electricity price review announced by the government and the terms of reference were issued in December. I think it's got a potential to be a little bit distracting. I don't think it's an existential threat, but it has got the potential to be a little bit distracting. And of course, as Graham mentioned, we do have an exposure to LPG product cost increases as a result of oil price changes. 2 weeks ago, I would have said oil was firming, but who knows? But we do think about how we pass through that cost to our customers, and we've not actually had to think about that for quite a few years, given where oil prices have been. So I think, in the short term, it's really a hydrology story as to how the year will pan out. But again, very confident in our portfolio. You can see the confidence management and the board have with the continued increase in the dividend. Part of the reason we're able to do that, of course, is that we've got a very strong focus on cash efficiency. We said at the half we would reduce our costs significantly year on year, and you can see at the first half of performance that we're well on track. We see no reason why we won't hit the lower end of that cash range when we're sat here in August. In the retail business, how we continue to do that is really important. And although I've led into this slide saying it's a retail question, it's actually a whole of business question, but particularly important in the retail world, given the levels of competition, given the levels of technology advancement. Moving more quickly to a more simple, more digital model is really important to us. The execution culture that we were looking for in customer has been embedded. I think you may see from us in the short term a repositioning of our brand around that agile culture we've built. But we will still be focused on best-in-class cost to serve, continuing to bring the performance initiatives forward. And as you know, I have a long-held view that scale will be important in that business, whether it's customer number scale or whether it's product scale. So that business longer term is really about agility and capturing those cost and scale benefits, which will be to the benefit of customer experience also. Decarbonisation sounds great. Lots of opportunity to look fantastic. But what's really going to make the difference in our portfolio? I believe it's the continued reduction in running a geothermal business. And you can see in the year we've really improved the performance of that operation, where we're now confident enough to say that average annual geothermal volumes are up at 3,350 gigawatt hours. We would have said 3,300 gigawatt hours, and that's with very limited capital. We don't expect to drill that resource until at least fin year 20. And the continued evidence of an improving cost of running geothermal, I think, is the single biggest thing we can do on decarbonisation. Because when that really takes off and when we can really see it embedded in demand, then there will be opportunity to develop more renewable into that. But you've got to be low cost. We will, in August, as we have sort of set a precedent of doing now, give you OPEX and CAPEX figures and target dividend numbers for the following year. And I fully expect in August to be evidencing in those CAPEX figures the great performance of the geothermal business. All of that in quite a volatile market with continued high levels of competition. We believe our distribution policy works. 80 to 90% of operating free cash flow. Target dividend announced each August. We are very comfortable that we're able to continue on that path, and I fully expect when our debt to EBITDA ratio reduces during the year, we'll be able to increase the dividend again to the full operation of the policy. And with that, I think I'm probably done. I think I started by saying pretty simple. Lots of things going on, of course, but the message we're giving is the distribution policy works, we will target the dividend, and it would have to be something major for us not to be paying it. So I'll go to questions. We have got a change format this year with the investment community and the media together, but I am going to go to the investment community first, and I'll go in the room first if there are any questions.
I have a couple of questions.
Yeah, Andrew will go.
All right, thanks, guys. The first question, I guess, was just around thinking about the second half, and I guess hydrology is going to be fairly key to that. At the moment, year to date, I think EBITDA is tracking around about 30 million behind last year, when you sort of look at January as well. How confident are you, I guess, of getting back towards being able to meet that FY17 number?
I mean, if I could predict the weather, I would have some degree of confidence, Andrew. But it is purely a weather question. You know, everything else is tracking as we expected. If we get a return to mean conditions in the next month or two, I don't think it'll be enough. I don't think we'll get there.
Yep.
But what I am confident about is the ability for the cash flow to stand up to support the dividend. So we might not get there this year, and it's purely a hydrology question.
And the second question, I guess, was related to the dividend, and obviously cash flow is probably a little bit behind on what you were hoping, just given the earnings results. By deciding to maintain, I guess, the FY18 dividend, implicitly we're talking about a slightly lower, perhaps FY19 dividend.
I mean, it's really the reason for the 80 to 90%. It gives us a degree of flexibility to ride through whatever hydrology or capital or competition might be doing to us. I think the market consensus for the 19 dividend is 37 cents. We're not expecting that to be in any danger. Obviously, we've got to go through a process with the board, see how the balance of the year goes. But no, we're not expecting to underperform against that market consensus on dividends.
And just last question from me. You talked about sort of, I guess, opportunities around decarbonisation, which I guess is electrification of more processes in New Zealand, and Tauhara. What's the current sort of build cost, sort of dollars per megawatt hour for that?
Well, as you can see, I mean, Mercury helpfully had an investor day late last year where they disclosed the cash cost of running geothermal. And you can see our cash costs are materially below theirs, and they're not fair comparisons because you do get different cycles, but you would say that the resource we have in Wairaki and Tauhara is a really good resource. I mean, the reality is, to get built, it's going to have to compete with firmed intermittent renewables. I mean, our assessment today would be that long-run cost of Tauhara would be in the order of $70 a megawatt hour, including the ongoing costs and the return on capital and so on. But that's why we're so focused on getting it, the performance to be as good as it can be, because it's going to have to compete with other fuels. Yep. The great thing is, of course, is it's off-scale and it's baseload, which does have some value. But yeah, we're not, don't be worried, we're not accelerating the spend of capital on Tauhara. What we are doing is accelerating our understanding of how to run a real world-class geothermal business. And then when we can connect Tauhara to demand, whether directly or through a sustained increase in market demand, then we'll be in a good position. But it's not the next couple of years, I suspect.
Yeah.
I think that's the questions in the room, so we'll go to the phone.
Certainly. Ladies and gentlemen, on the phones today, if you wish to ask a question, please press *1 and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question today comes to the line of Grant Swainpole. Please go ahead.
Hey, Grant.
Morning, team. A couple of questions. First, the pricing on the retail book is obviously lagging lines increases. Do you expect this to change a little bit in the second half of the year? Second question, just to follow on from Andrew's. You mentioned decarbonisation, and Fonterra is starting to talk about having spoken to electricity companies. Are you in any dialogue with them, and do you think that could lead to anything in the next couple of years? And then the final question, are you guys progressing with your telco strategy? Does the SAP system ride quite easily, putting that on top of the existing platform? Thanks.
Okay, I think I can handle all those. I don't need to pass. On retail, I mean, in the first half, you'll have seen a fair bit of variance as a result of volume. But also, we didn't change our prices until August. We had a transition from Flybuys to Smart Fuel, and therefore you wouldn't have seen as much of an impact in the first half on our numbers. In terms of pricing going forward, clearly the competitive market speaks. We have got some price changes in train at the moment to a proportion of the customer base. A lot of the customers are on fixed prices, of course. Genesis increased prices largely across the board in January, 3 to 4%. So you can see that the underlying base price does move, and we intend to move some of ours. But the realised price just isn't keeping pace with network cost increases. And And we expect that to slightly improve over the balance of the year, but I wouldn't be calling out an earnings revision on that basis. In terms of Fonterra, yes, we talk to them. We're obviously a supplier to them at Tirapa. We are helping them with a couple of projects. Does it turn into a capital investment in the near term? Probably not. The great thing about our portfolio, of course, is that we can support any customers going renewable now, given the percentage of our production that's renewable, and then build into it in due course. You're more likely to see actual customer contracts on smaller things like commercial solar. We're engaged formally and informally on a couple of smaller projects there. And then in terms of SAP and telco, I think we're at the 1,000 customers now on broadband, and we said we would review 2,000 customers as to whether the cost to serve is manageable and we're getting a return from those sales. In terms of the IT behind it, it's been actually remarkably smooth. We're seeing no issues. Customer experience is very smooth. So we think SAP is absolutely scalable for what I would say are simple line item billing products. So yeah, we see no limit on that. We're not going to buy 200,000 Slingshot customers, so we're not going to test that to that level, if that was behind your question.
No. Dennis, can you still hear me?
Yes. Yep.
Just to follow on from the Fonterra one, do you think energy companies are going to be able to shape the government's review at all and maybe push the decarbonisation story a little bit harder than what seems to be in the agenda at the moment?
I think so, and I think the way we can shape it, Grant, is by evidencing the capability of the sector and that the resource is there, the capital is there, and we can deliver. So part of the reason, I've emphasised geothermal is because, we're ready to go. We just need to be able to see a return. So I think increasingly that will shape the government's view. Reality is, in the 100-day plan of the government, albeit they've got this electricity price review on the cards, we've not really been a focus. They're on other matters at the moment. But I think as the progression of a climate change commissioner goes forward, I think we will have quite a say in shaping the timing. And my household went full electric vehicle 2 weeks ago, Grant, so, I'm doing my bit.
Your next question comes from the line of Stephen Hudson. Please go ahead.
Hey, Steve.
Hey guys, how are you?
Good.
Just a couple of quick questions. Dennis, one for you, just on your cost to serve. You talked about scale and scalability. Can you give us a feel for what you think the true variable fixed cost split is within your cost to serve, and perhaps your view on industry cost to serve as well, what the split would be there? And then maybe one for Graham, just on the USPP bridge loan. I just wondered if you can run through what your thinking behind putting that in place was.
Yeah, I'll go. Graham needs less time than me to think about that question. The cost to serve in the industry is a little bit opaque. I think we're the most transparent. We would say our cost to serve averages just over $200 a customer. You might see a figure more like 150 in Australia, so if you're looking at what does scale really mean, that's what Australia's able to get to. We would say a little over $200, we're the cheapest, if not the second cheapest, cost to serve. And the fixed variable split is probably in the order of 50-50, you would say today. The 50% that's fixed, it doesn't really, particularly IT costs. We've got a lot more customers or products we can add before we're changing the nature of those fixed costs. I mean, roughly a third of cost to serve is people. So one of the things I noted in the slides is that the digital evolution of our business is not really a bolt-on, it's fundamental, because I think it will fundamentally change the nature of those fixed and variable costs. But if you were looking for a rule of thumb, I would go, it's in the order of 50-50 fixed variable. We've previously thought it might be 60-40, but digital journeys for customers is changing the nature of that mix.
Stephen, it's Graham. On the question on the bridge loan, what we've done, we've got a couple of USPP tranches maturing the first half of calendar 18, and a wholesale bond, in fact, maturing in the same period. So we've put in place a bridge loan which we'll draw down to repay those notes and the bond, and then at some point, probably in the second half of the calendar year, we'll look to refinance the bridge loan through whatever mechanism at that time is most attractive.
Okay, thanks, guys.
Steve, any more on the phone?
Just a reminder, ladies and gentlemen on the phone, if you do wish to ask a question today, please press star 1. Thank you. There are no further questions at this time. I'd like to hand the conference back to today's presenters. Please continue.
Okay, so thanks for those questions. Happy to take questions from, I don't know what I refer to you as a collective, the media, I suppose. And don't
like to refer to this.
You don't want to hear that on a public forum, Patrick. Depends on the questions. You ask your questions, and then I'll decide what the collective is. So, any questions?
I'll save mine for the one-on-one.
Okay.
Can we get a little bit of detail on the new gas contracts? It looks like about 12 PJs, and is that, is there any changes in the structuring of the contracts? And is that a maximum available, or?
I mean, we've only bought winter this year, short, and so there's no duration to the contracts. Did we disclose it?
Yep, it's on page 37. Basic.
On 37. There's no duration to the contract, and it's got a ROFA-like flexibility. So a swing of 80% to 125%. So reasonably flexible.
Yeah, it will be to inject into AGS. So
Yeah.
Got the ability to absorb the contracts within the injection to AGS or usage into winter demand periods.
Okay.
I mean, I do now know there's a connection between signing a gas contract and it pissing down the next day.
There you go.
I was on holiday, Graham signed it, and then it rained. Which is why the gas storage facility is useful, because we can, if we get into strife on take or pay, it's now so small that it gets injected. And in fact, a bit of re-injection wouldn't do us any harm, because we're a little bit low in the tank at the moment. So even if you saw, sustained inflows, then it'd quite usefully be topping up the tank. Which is why the cash flow works so well, because we're spending money on gas, injecting it, but our cost of goods has come down because it's raining, so you still see quite a good cash flow profile.
Sure. And just on sort of gas-related questions, obviously you had TCC open. Did you do anything different with that project, and did you learn anything that you hadn't expected with the plant?
We've learnt it's tripped about 3 times since we maintained it. No, I mean, every major maintenance gets the benefit of all of the major maintenances in the world. Yep. Now, GE are new to that plant, because it was Alstom last time it was maintained. GE historically have been very good at bringing the best performance improvements from other plants. We didn't really get much on this one because it's new to GE, But you do get a slight heat rate improvement. You do get some lower chemical use, but it's pretty minor actually. We took the opportunity to do some balance of plant stuff, which, you know, once we're through these teething weeks, should give us some long-term operational reliability.
Okay. And you think the recent trips are literally teething?
Well, I mean, we reconfigured the burners as part of the maintenance, and that caused a bit of teething in early January. The trips that have occurred Friday and today, we actually don't know right now. But we do know, we've always known that TCC is sensitive to richer gas.
Right.
And at the moment, Coupe is running flat chat, and it's probably got some richer gas in the gas stream, and that does affect the whole system, but that's me connecting what might be two unconnected things.
Okay.
But we've got a bit of water and we've got the peakers, so it's not stressful, it's just a little bit annoying.
Sure. And the work at Tamihi? No surprises there, or?
No, I mean, there was two things going on. The pressure vessel inspections, which was the 2-year inspection, and now that gives us 4 years. I'm looking at Matt, so we've got 4 years before we have to do that again. And I think most of you would know we had some sagging of the turbine hall concrete plinth. And we, at the same time, we put a metal frame in to hold up the concrete plinth and stop the sagging. That looks very successful. 150 tonnes of steel per unit, and it looks like it's moved at 1.2 millimetres, which is perfect, which is what we need, and it looks like it stops sagging. So the works were very successful. I mean, I wouldn't be saying 3350 gigawatt hours if I didn't have confidence in that. I mean, the good thing about all those maintenances that we've done in the last few months is, you know, safe, on time, but they are major pieces of work.
You didn't say under budget.
Well, TCC will probably come in under budget, but they're all within the 70 to 80 million, which we have confirmed as 75 million for the year. So they're all within that number. Harold was a little bit more expensive. The steel frame that's holding up the Tamihi concrete looks remarkably like a giraffe, so it was called Harold. That's high humour in engineering.
Is there any liability that rests with anybody for having poured the concrete in such a way that it's sagged, or was this just subsidence?
Yeah, I mean, I think it wasn't subsidence. We know all about subsidence. We can manage that quite well. It was a design error and a construction error for that concrete to be sagging, but we settled all claims with the contractor a year ago. And I will remind you, we had about $54 million out of the contractor. So, I mean, the Harold was a few $1 million. It wasn't huge. So no, there was no one to go after. We've settled all our claims on Tamihi about a year ago.
How are you judging the success of moving from flybys to the BP scheme, and how is that going against whatever that measure is?
Yeah, well, there's a few things. I mean, you can look at the cost of the scheme, and the cost of the scheme is pretty similar. You can look at the MPS of the people who get smart fuel points, and you can look at the more macro numbers of churn relative to market. But the reality is there's only a proportion of the customer base have taken up the incentives. They've got very high MPS and very long tenure. So it's done over a few measures. We would say tick on the transition. We've got some very strongly advocating customers with smart fuel. But I believe in future it will only be one incentive in a wallet of many incentives. So I think the thing that we were worried about at the transition was that it would be all defining for the customer base, but it isn't really.
Dennis, can I put one with you as well as just along with you?
Yeah, we've got time.
I'd still like to ask a couple of questions, if I don't know. One is, I don't know if I understood this correctly, but was there a $9 million loss on selling to Tiwai Point? There's a $9 million unfavourable movement in EBITDA. Did you actually make a loss on selling to the smelter?
Depends how you look at it.
Yes.
I mean, we get more than our cost of production from the aluminium smelter, but we receive less than we would have done from other sales channels. And the difference is actually is versus other sales channels.
It's a half-on-half comparison. So in the prior half, that volume of sales was generating a higher net back than it is when we use it to support Tiwai.
So the point of having it then is because you've got a guaranteed 80 megawatts, whatever it is, and therefore that's a sale in the hand, even if it's a lower price.
That's one benefit, but the wider benefit clearly is to encourage the smelter to stay.
You're obviously not giving figures because it's all commercially sensitive and their price is totally no-go area anyway, but I would have thought that even if it was, say, something like 6 cents a kilowatt hour, that would be less than I would have thought your cost of production would have been during a drought.
I mean, if you look at the way we recognise it's a 14-year contract, and for 14 years we won't be in drought, hopefully. Well, we might see a change in the retail market if we were in drought for 14 years, but that aside. The way we costed it was to look at the marginal production through TCC. And the marginal production through TCC is actually lower cost than the sale price to the smelter. So we don't make a loss on our production in any hydrological circumstances. What we do is not have the opportunity to sell that power to what might be higher priced channels. But the benefit, of course, is a market-wide effect of the smelter staying. But also it does have some portfolio benefits for us in that the smelter is close to our hydro production. The first 6 weeks of that contract were fantastic because it was raining, and then it stopped raining. So, you know, on many measures it was a good decision. If you were looking to build a power station today, you couldn't justify it on that price. But we do make a profit versus our marginal cost of...
Is that because the cost of your TCC or sunk costs are gone, and so it's your operating costs?
Yeah, and fuel costs, yeah. And the reason it's showing in that chart is that in the prior period, we didn't have that contract. So we're just showing effectively the mark-to-market difference between what we would have sold it into other channels at.
Can I ask one more question? On this inquiry, you say it's distracting, but it's not an existential threat. How necessary is it? Is it perhaps a bit of a waste of time? I mean, is it not really germane to the point of what things really are?
Oh, I mean, I think you can see in our results that the retail market is competitive. You know, our prices are not increasing on average. Customers are getting more choice, a different range of products. So we're not sure it's needed. We do see that there are some benefits of it having a future focus. You know, if we look at what could usefully change in the system to enable a more technology-enabled customer base, such as the structure of the distribution companies, the way they are charging, the removal of the low user fixed charge. We see that there are some potential benefits from a review, but the industry has been under review since 1999. There's an awful lot of data available. There's an awful lot of recommendations out there. If this review provides some clarity and allows us to move on, then that would be good. But right now, you know, I think the industry's healthily working to the benefit of consumers and managing that balance of shareholder and community needs. So we wouldn't say it was needed. We're not scared of it because we think our part of the sector works reasonably well.
Can I ask you about the UDL legal action? Why is that issue sufficiently significant to make it worth going to the High Court about?
There's been a few legal actions. I think it's about precedent, Patrick. If this is the case which is related to who bears the cost of a power line outage,
yes,
whether it's the retailers, the distributors or the customer, I think it's very important from a precedent perspective that the retailers are not left bearing the cost of any cost to consumers of the failure of power lines. So it's a really important precedent case, and it's really important that UDL are very clear when they make these judgments.
So what are the implications if the judgment they came to in this instance is upheld?
Well, we'll keep fighting it, of course, through other avenues. But the implication is huge for the sector in that retailers would bear the underperformance of the network. And that could be a high cost.
Has there been some sort of shift in the way that the UDL is approaching these issues since becoming UDL? Why hasn't this arisen before?
I mean, be careful what I say, but I think UDL have become much more of a customer's champion in the way they consider their judgments, as opposed to an objective decision maker. So I think it has changed. Anything else on the phone? I wouldn't have thought so.
Just a reminder, ladies and gentlemen, if you do wish to ask a question today, please press *1. Thank you.
Right, all good. Thank you all. Obviously, we'll see most of you during the week. You've got a busy week, I suspect, with various results and other telephone conversations to listen into. Okay, see you later.
Thanks very much.